Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar.
Hey, good day, everyone. Welcome to another Cambridge podcast. Today's podcast will be part 2 of Principles of Financial Economics. As you may recall, we did part 1 last week, and it was very exciting. I received no less than 30 emails regarding some of the questions concerning the items we covered last week in the Financial Economics podcast. As you may recall, one of the things that we talked about was the fact that, we always try to take a risk management approach to retirement planning. And there's something that we call the fatal 4, which are the 4 major risks that are going to be facing all of us and that are facing all of us not only today, but will be facing all of us in retirement, which is, the impact of dying too soon, the impact of living too long, the impact of living with a disability, and last but not least, the impact of living with eroding factors. So we spent quite a bit of time and quality time last week in the first 2 of the fatal 4, which was the area of dying too soon and living too long, and the impact that those issues and concerns may have on you, your family, and your business throughout retirement. The other thing that we did talk about is we discussed briefly the 3 taxable buckets and why it is so important to always have the 3 taxable buckets in mind as you prepare to take money out of your retirement accounts and your assets, and how do you distribute the assets in a way that is going to be most feasible and recommendable to all of you. So in today's podcast, again, I want to cover part 2 of the financial podcast that we started last week. But today we're going to be dealing with the last 2 of the fatal 4, which is the risk of living with a disability and then the risk of living with eroding factors, and what are some of the issues and concerns that you need to be aware of. But most important, what are the things that you need to start doing and that you need to start preparing for in order to mitigate those issues at some point in time in the future. So let's get into it. Let's start talking a little bit about the risk of living with a disability. One of the major challenges that we're having today in the United States is that people are living a lot longer. In last week's podcast, we talked about the risk of dying too soon and then the risk of living too long. Well, the vast majority of Americans are living a long life. 30, 40 years ago, what used to kill us is no longer doing that because of medical technology and advances, but it doesn't mean that we're going to be any healthier. As a matter of fact, the fact that people are living a lot longer today than ever before, that brings about the issues of living with a disability. So issues like Parkinson's or Alzheimer's or having strokes or having any type of bone density issue, as you get older, may require and more than likely will require the assistance and the service of long-term care providers. Now, one of the things that I discuss with clients on an ongoing basis is that if you have a husband and wife age 65 today, in fairly healthy shape, so they're fairly in good shape at the age of 65, there is a 75% probability, yes, a 75% probability that one of them is going to have a need for long-term care at some point in time in the future. Now, you can mitigate long-term care in a number of different ways, and we'll discuss that in the next few minutes. But long-term care is a progressive, for most Americans that have a need for long-term care, it becomes progressive as time goes on. So in the very beginning, as you're getting older and now you're having long-term care issues, you may be having home care, meaning that yes, you have issues and you have a debilitating disease or something along those lines, but you can still try to get around a little bit. So you may have the ability to stay at home and have someone come in and check on you from time to time, but you are still maybe not 100% self-sufficient, but you're probably somewhere about 75 to 80% self-sufficient. And that could go on for a number of years. That could go on for 2 years, 3 years, 4 years. It really depends on what it is that you're dealing with at that time. Now, once your illnesses or the issues that you may have start to get more and more progressive, you may have to go from home care to some kind of a facility, home health care facility, in which now you're going to start to receiving care and assistance on a full-time basis. And then obviously as you progress through that, because there are limitations as to what you can do or what your assisted living facility may be able to do for you, depending on the illness that you may have, you may get to a point where now the assisted living facility may not be suitable for you any longer, and then you need to perhaps move into a nursing facility, a nursing home. Obviously, all three of them come with a challenge. I have had a number of clients that have had a need for long-term care. I have some clients right now that are dealing with long-term care issues at this point in time. I think what is critical to understand is that long-term care, not only does it impact you, the person that is going through it, but it also has a tremendous impact, and many a times a negative impact on members of your immediate family. So what are some of the things that we recommend? And by the way, a disability, whether it's a long-term care after you retire or a pre-retirement disability, can happen at any point in time. The same way that I always say that tomorrow is promised to no one. When it comes to the risk of dying too soon, the risk of disability, it's prevalent, and it could happen to all of us. There's a very high percentage of Americans today that are disabled, and they're not yet in retirement, and that poses a number of different questions and concerns regarding the viability of having a good, strong retirement life. So some of the suggestions that I would make in dealing with the risk of living with a disability is that during your years of employment, it is very critical that you maintain group disability benefits if available. If you happen to work for a company that provides employee benefits, and one of those benefits happens to be group disability benefits, then it is very, very important that you sign up and obtain as much group disability benefits as you can possibly afford. Group disability benefits, for the most part, they're not very expensive at all. The benefits are taxable unless you're actually making contributions from a premium perspective, or you're sharing in the premium that is being paid to the disability company. And then if you happen to become disabled, then that portion of the premium that you share will equate to a portion of the disability benefit that you will be receiving, and then those benefits would be tax-free to you. But the benefits that are being earmarked and paid for by your employer when you do become disabled will be fully taxable to you from a taxable perspective. Now, in addition to maintaining a group disability policy, you should also have your own personally owned disability policy. And the reason for that is twofold. The vast majority of Americans today are changing employments on a regular basis. And that means that, as opposed to, in our parents' lifestyle and work style, where they may have worked for the same company for 20, 30, 40 years, very seldom do you see that in the marketplace today, unless you happen to be a public sector employee, you work for the government, so you start with the government and you plan to retire from the government. But in the private sector, you don't see that as often anymore. Well, what happens is our group disability benefits are not portable, meaning that if you leave your company in your employment and you have a group disability benefit, that benefit stays at the company and no longer follows you. So therefore you no longer have that insurance. So always having a personal disability policy is very critical. By the way, on the group benefit side, the same thing happens with your life insurance. If you have group life insurance, very, very few companies will allow portability, and if they do, then you're going to have to convert it to a personal policy, which could become, more expensive than it was, and will become more expensive than it was under the group benefit. So it is critically important. Now, the average cost for a personal disability policy, depending on the type of riders that you're going to obtain, is going to be anywhere between 2 and 2.5% of your salary if you're fairly healthy. So if you're making $100,000, your disability premium for a personally owned disability policy that would be fully portable to you may cost you anywhere between $2,000 and $3,000. So from a business standpoint, I would rather make $100,000 and pay $2,500 or $3,000 toward the disability policy and then net out prior to income taxes $97,000 than becoming disabled, not having a personally owned disability policy, and now my income goes from $100,000 a year to zero. So that's something that's very important. Now, most personally owned disability policies, they come with the ability for you to buy additional coverage based on income increases. So for the first, let's say, 5 or 7 years of your personally owned disability policy, the company may send to you a letter stating that you do have the ability to buy up additional coverage at no underwriting risk whatsoever. In other words, you don't have to apply for another policy. You don't have to obtain or do medical exams again. The insurance company has already in the riders, so they will offer you that additional coverage in order for you to be able to mitigate the increases that you may get from employment or business, and also to offset inflation, because obviously inflation is eating away at your purchasing power every single day of every single year for the rest of your life. So these automatic annual increases are very, very good, and I urge each and every one of you to try to maximize those benefits if you have a personally owned disability policy. Now, when it comes to long-term care protection, is paramount at retirement. And obviously there are different ways in which to mitigate those risks. For many years, if you wanted to protect yourself against the risk of living with a disability in retirement, then you had no choice but to purchase a long-term care policy. And long-term care policies are very good, but they're also very, very expensive. As a matter of fact, because of the fact that the cost of long-term care liabilities for most insurance carriers is very difficult to forecast and to actuarially forecast, the premium increases can happen at any time. And the other challenge that I bring to the table when we visit with clients is, look, if you're age 50 and you buy a long-term care policy, what would happen if at the age of 85, 35 years later, you happen to die in your sleep? Well, if you bought and purchased a traditional long-term care policy, you paid premiums for 35 years, and then you went to bed and you never woke up. So you pretty much died on the side of the angels, and that's a way that most of us would want to pass on. None of us would want to deal with long-term care and so forth. But from a financial standpoint, here's basically what you have done. You purchase a policy at the age of 50, you pay premiums every single year, and at the age of 85, you passed away in your sleep. Therefore, you had a tremendous opportunity cost in the purchase of that long-term care policy. Because, number one, you paid premiums every year that you could have used to do something else with. And then it's not only the premium that you paid, but also the internal rate of return on that premium, because if you had taken that money, if you had known that you were not going to need any long-term care, and therefore you could have taken that premium of, let's say, $2,000, $3,000 a year and put it into an investment account. Let's say you invested $60,000 over a 35-year period in long-term care, or $70,000 along those lines. Then if you had invested that money at anywhere between 4 and 5% rate of return over that same same 35 years, you would have had an account with values between $110,000 and $125,000 at age 85. So that is one of the major challenges that we have always had with clients, that yes, there is a risk for living with a disability, but what if you die in your sleep? That premium and what that premium could have done for you is pretty much lost and negated to you and your family for the rest of their lives. So what insurance companies have been doing lately is a number of very reputable insurance companies have brought to the table annuities and life insurance policies that have long-term care riders. So for instance, if you are age 50 years of age and you are concerned about the risk of living with a disability, you can purchase a life insurance policy that has a long-term care rider. And what that would do is would give you the ability to maximize the internal rate of return on that benefit that you're paying for, because whether you need that benefit in the future or not, someone is going to receive the benefit at some point in time. Let me give you an example. Let's say that you purchase $1 million of life insurance, and it has a long-term care rider. And you're age 50 and you pay the premiums for 35 years. There are some policies that you can prepay the premium if you want to, if you don't want to pay it for 35 years, and those would be more of your 7702 plans. But if you're just buying a life insurance policy to protect you from the risk of dying too soon or living with a disability, then obviously that would be a suitable vehicle for you. Because if at the age of 85 you died in your sleep, then the $1 million of death benefit proceeds will go free from federal income taxes to your beneficiaries. But what if you had a need for long-term care? What if at the age of 81 or 82 you had a need for long-term care, and you were in a long-term care or assisted living facility or in a nursing home for 3 to 4 years, and you had $1 million life insurance policy, and you used up $500,000 in order to cover your medical expenses and your additional expenses due to a long-term care issue. Then at the time that you pass away, whatever remains inside of that contract will then go again to your beneficiaries free from federal income taxes as well. Obviously, if you used the long-term care in its entirety, because let's say you had Alzheimer's and you had to spend 7 to 10 years in a facility, and you qualified for long-term care under the 2 of the 6 activities of daily living, which includes, bathing, continence, and so forth, then obviously someone will always get the benefit. So at the end of the day, I always ask my clients the same question. And the question is, if I can put you where you want to be, why should it cost you money? Because if you buy a long-term care policy and you get what you want, which is you want to be able to die in your sleep on the side of the angels, then that policy costs you a lot of money. But if we can do it in such a way where you can use an annuity or you can use a life insurance policy that provides for those long-term care riders that are so critical and beneficial to you, then whether you have a need for the benefit or not, someone is always going to receive the benefit. So the internal rate of return and the maximization of each dollar that you're setting aside for premium is actually worthwhile to you. Now, on the annuity side of the house, it works pretty much the same way. Let's say that you have $500,000 in a CD, $100,000 in a CD, $250,000 in a CD or more. Any number would be fine, and you decide to purchase a long-term an annuity. Well, there are annuities nowadays that provide a long-term care rider. Index annuities, and we deal with a number of companies that provide these benefits to our clients, where our clients can get their cake and eat it too. They can have their cake and eat it too, because they have an annuity in which they can start to use at some point in time in order to maintain and sustain their retirement income throughout retirement years. But if they have a need for long-term care, that income that is being received will actually double to provide the additional and cover the additional expenses from a long-term care necessity. So the same thing as with the life insurance, someone with an annuity structure will receive the benefit. And this is where we start using annuity straddles, we may do either a straight annuity with a long-term care rider, or we do a life insurance with a long-term care rider, or we do a combination of both. It really depends on the amount of coverage that we need to obtain. It depends on the finances of the individual client, and obviously what the opportunity cost would be at some point in time. So, hopefully this is giving you a little bit of flavor of things that you can do in order to mitigate the potential risk of disability, whether it's in pre-retirement or post-retirement. Always be protected, because insurance is only expensive if you don't need it. Because when you do need it, insurance is the cheapest tool that you could ever have in order to assist you and your family in mitigating all of these risks. Finally, let's talk about the risk of eroding factors. And this is one of the major risks that we bring to the table whenever we deal with clients from a business perspective. Because yes, you may be making $3,000, $4,000, $5,000, $10,000 a month today, but unless you're able to mitigate the risk of eroding factors, that money is not going to buy you the same amounts of goods and services 10, 15, 20, 30 years from now, especially when you need to plan for at least 3 decades in retirement. So the risk of eroding factors is very critical. And here's where we use the tax buckets that we have been talking about, the taxable bucket, the tax deferred bucket, and the tax-free bucket. In this scenario, we primarily use the tax-free bucket, because the bigger your tax-free bucket, the lower your tax liability. See, one of the major eroding factors that we have is taxation. So we have taxation, we have inflation, we have stock market volatility, we have interest rate volatility, we have financial fees, we have lawsuits, we have propensity to consume, we have maintenance, because obviously you may own a home, you may own automobiles, you may own some real estate properties, and obviously maintenance and repairs going to have to be done. So all those things are going to erode the income that you're going to have in retirement. So the bigger your tax-free bucket, the lower the tax liability, because everything coming out of your tax-free bucket will not be susceptible to federal income taxes. So that is a great way for you to minimize the risk of taxation in the future, and to become a less issue from an eroding factor perspective. Now, the more assets in guaranteed accounts, the lower the risk of living too long, the lower the inflation risk, and obviously the lower the stock market volatility risk will be as well. I deal with a lot of clients that are now in retirement, and just about each and every one of those clients would tell me that they would rather have guaranteed income than non-guaranteed income. And that's very, very important. The other thing is that the vast majority of my clients are more interested on the return of their money than the return on their money. So having guarantees is very critical. I did a podcast not too long ago where we talked a little bit about market volatility, and we talked about the sequencing of returns. See, when you're in pre-retirement and you're accumulating assets, the sequencing of returns really doesn't play such a major role, because if you have 10, 15, 20 years to retirement and the market were to drop, you're not needing that money. You continue to fund your 401ks and your IRAs, and obviously over time the market is going to recover and you should be okay. The problem is that when you're in retirement, you're going from people at work to assets at work. And every single year, you're going to have to dip into your accounts, whether you want to or not, because obviously you're now used to eating 3 times a day. Now you may want to cut it down to twice a day, but I'm sure that's not going to work. And you need to maintain your standard of living. So if the market goes south for 2 or 3 years in a row, especially early in retirement, you're still going to have to take money out of those accounts in order to maintain your standard of living, and that's going to exacerbate the liabilities and the losses that you're going to have in the account, because it's not only is the market bringing your account value down, but also your consumption of some of that money on an annual basis will continue to deplete that account, and many times at a faster pace that you would want to. Now, inflation is another major risk that all of us are going to have to deal with in retirement. All of you are going to have to deal with in retirement. And what I do tell my clients often is that, inflation is not tax deductible. So if inflation is at 3%, you may have to earn 4.5% on your account just to stay ahead of inflation. And by the way, inflation is nowhere 3%, it's higher than that. Now, the CPI that the government puts out leaves a number of issues outside, like energy prices, food, and gas prices. So obviously, and healthcare. So obviously, if you take those issues out of the table, when you start to figure out what is the inflation rate in the United States, of course it's going to be lower. But when you add all of those issues that are so critical to all of us, you will find yourself that the average inflation rate in the United States today, for at least the clients that I deal with, is north of 4%. And obviously it doesn't include taxes, because again, inflation is not tax deductible. Now, I think it's important during retirement that you reduce your propensity to consume and be aware of financial traps. So not only do you want to have the ability to take income out of your retirement accounts without having to pay federal income taxes, because obviously you don't have to take as much risk in order to try to grow your assets, because you're not paying the federal government any taxes on that distribution, and you're doing that legally, so you're not doing anything illegal. But by the same token, the fact that you're not paying taxes is helping you offset inflation risk as well and market volatility. But also bear in mind that you're no longer producing when you are in retirement, unless you have some real estate investments and so forth, or you're still working part-time, or you may be doing some consulting work. So you gotta be very careful, and you have to be able to reduce your propensity to consume. So if you were the type of individual that would buy new cars or lease cars every 3 years, well, if you're someone that leases, maybe you want to buy an automobile. You want to keep it for 10 years, take good care of it. I have had cars for 15 years, and they're incredible. They because I do take care of my cars the same way that I take care of my properties and my homes and so forth. So your propensity to consume is something that you're going to have to deal with in retirement. And the better job you do at that, the better off you're going to be in. You're going to be avoiding all of those financial traps that come from not being able to manage your propensity to consume services and goods in the United States. Another issue that could erode your assets and that of your family as well is, make sure that you have an up-to-date wills and trust. Make sure that your wills and your trusts are up to date. If you happen to die, let's say in the state of Florida, every state is different, but every state in the union is going to have their own intestacy laws. That means that if you die, let's say in the state of Florida, and you don't have a will and you don't have a trust, then the state of Florida is going to apply their own will to you, because they feel that, if you didn't care enough about yourself and your family to be able to mitigate those issues, and you died without a will and a trust, then obviously you're going to have to apply the intestacy laws of the state of Florida and any other state that you may be living in at that time, in order to figure out what's going to happen to your assets, who's going to get them. Are they going to have to be probatable? In other words, are they going to have to go through probate? And by the way, probate can take anywhere from 9 months to 3 years, depending on how much assets do you have. And obviously, when you go through probate, there are fees, there are expenses, now you're falling into the financial traps, and your family is falling into the traps. If you have minor children, guardian ad litems are going to have to be appointed. These are attorneys whose sole responsibility is to care for those minor children, and they're going to charge a fee out of the estate. So you have to be very, very careful about that. And I always recommend that everyone should have at least a will and a trust, and within those items, you need to have your durable powers of attorneys, your healthcare proxies. You want to give power of attorney to someone that like and trust, that can make decisions on your behalf at a point in time where you cannot do it for yourself. What if you were involved in an accident? What if you had a stroke and all of a sudden now you're in a coma, and you need someone in your family to make a decision, but you never signed a proper document, healthcare proxy, in order to have someone have power of attorney over you. Then these are things that are very critical that most Americans and most of the clients that I deal with, have not really thought about much. Nobody wants to talk about death, because, obviously nobody wants to die, but we all do, and no one ever dies at the right time. So it's important to have your wills and trust in place. Do not attempt to prepay your mortgage by sending extra payments through your mortgage institution. It's not a very good way of doing it, because at the end of the day, there are only two ways that you can be safe in a mortgage. One, when you no longer have one because your home is paid for, or when you're fully leveraged in your mortgage, because the more equity you have in your home, the more leverage the banking institution has over you. So if you're going to send an extra payment a year, or let's say if your mortgage is $2,000 a month and you want to send an additional $500, well, you're better off taking those $500 and putting them in a separate account, especially in your tax-free bucket, and have that money grow on a tax-deferred, on a tax-free basis on your behalf. And if you say, well, I have a 30-year mortgage, but I want to pay it in 15 years, then you can do the calculations and put enough money into that tax-free bucket at the end of the 15th year for you to have sufficient assets inside that bucket, whereby now you can pay off your property if you wanted to. But in the meantime, for those 15 years, you were able to enjoy your higher deductions, and you were able to receive certain benefits that you wouldn't have been able to receive to its maximum otherwise. So and not only that, you would have had a lot more liquidity. Because what if you're trying to prepay your mortgage and 2008 happens all over again, and you lose your job, and you can no longer pay your mortgage? You can't go to the banking institution and says, I actually prepaid 5 years of mortgages up until last month when I lost my job, but I can't find a job right now. Do I have to pay my mortgage next month? And the answer is going to be yes. Banks don't care. So you want to have the leverage, and you want to be able to protect that and have that protection on your side of the ledger, not on the banker's side of the ledger. Now, you also want to try to, in order to mitigate and minimize your eroding factors, you want to try to avoid the compounding effect of your assets unless you have the ability to compound the interest earned but not the taxed. So the way that most Americans invest their money is, they want to compound their interest, so they want to put the money in which the interest is compounding. Is one of those wonders of the world, the compound interest. But it's also compounding the tax. So on one side of the ledger, the compounded interest is good for you, but on the other side of the ledger, the compounding tax is not. You could also opt out to have simple interest, okay? And you can also have compound tax. Now you're starting to do simple planning, because traditionally, people that have compound interest, they also have compound tax. But what if you can have simple interest and obviously simple tax? Well, that's something that you can deal with. Obviously, the simple interest is not earning as much as your compound interest, but your tax liability is a lot lower than if you had a compound tax liability. But in a perfect world, you would want to have compound interest. You may want to have simple tax, or you may want to have compound interest and zero tax. So let me explain this very briefly for you. What if you could have an account where your interest is being compounded, but your taxes are simple taxes? See, there you have an edge. You have an edge over the compound interest and the compound tax. Now, unless you're dealing with somebody that has background in economics and is a retirement strategist, the probability that you're going to be able to do that for yourself is going to be slim to none. But if you work with somebody that specializes in tax planning, then you may very well be able to have a compound interest and simple tax. But now I'm going to bring you to the top of the world from a taxable standpoint. What if you can have compound interest and zero tax? And that's where you try to truly maximize the tax-free bucket in order to continue to generate the compounding effect of those assets while reducing your tax liability to zero. So as you start to work with the fatal four, which deal with the risk of dying too soon, the risk of living too long, the risk of living with a disability, and the risk of living with eroding factors. If you're able to mitigate those risks prior to retirement, then you have done an incredible job for yourself, your family, and your business for the rest of your life. Benjamin Franklin said once that, tell me and I forget, teach me and I remember, involve me and I will learn. And what we try to do with these podcasts and the seminars and the webinars that we do on an ongoing basis is to provide education, because information without education always leads to failure. So the areas that we talked to you about today are areas that are critical important. And if any of you have any questions or you want to reach out to me, please feel free to reach out to me at bert.salazar, SALAZAR, at cambridgefpllc.com, or Bert, BERT, at bertsalazar.com, or you can also call my office at area code 786-766-1042, again 786-766-1042. And remember, my number one goal with all of you is to kind of help you change the way that you see things. Because when you change the way that you see things, the things that you see change. So again, thank you so very much for giving me a little bit of your time today, and I'll talk to you again next week. Thank you. Take care. Bye-bye.